Hi, folks. I'm going to present very interesting data today. Uh, the title of the video is Why Missing Few Days Costs You Everything. You will be surprised by the data that is presented. So let's take an analogy. It's a World Cup final day, and the match has started. Early overs are feeling slow, and then you just step away for a couple of overs for some work. And when you return, maybe three wickets are gone. The momentum in the match has shifted and you missed thrilling moments of the match and you're not very happy about that. Investing can be the same also. You skip the best days in investing and you skip the moments that make the journey worthwhile. Let's deep dive. So let's assume we invested 10 lakhs in the year 1999 and we've continued to hold them. Let's say we invested in Nifty. Uh, if we didn't do anything, that money has grown to from 10 lakhs to 3.05 crores, uh, and that's all good. But if we miss the best 5 days, just 5 days out of this entire period of almost 26 years, can you guess what would be your portfolio value today? It is down by 38%. So instead of 3.05, you would be sitting at 1.9 crores just by missing the best 5 days of the last 25 years. Isn't that an amazing stat? That significant compounding has been lost by just missing 5 days. 6,447 days total, and you remove 5 days, and 38% portfolio value is gone. So, what if we would remove 10 days, 15 days, 25 days, and even 50 days out of this period? And this is the chart which is showing you that entire calculation. If you miss the best 10 days, you are down to 1.38. 15 days, you're down to 102. 20 days, 0.78. 25 days, 0.6. 30 days, 0.47 crores. And best 50 days, you're at 20 lakhs. 10 lakhs is 20, becomes 20 lakhs in 25 years if you miss the best 50 days. Of course, this is theoretical and nobody is expected to miss the best whichever number of days. But 94% value of the portfolio was made in 50 days out of 6,400 and odd days. That is the beauty of the data that is being presented here. Now let's understand this better by using an example of three investors, A, B, and C. Mr. A is the lucky investor. He magically avoided the five worst days each year, let's say. Mr. B is the neutral investor. He stays invested throughout without any change. And Mr. C is the unlucky investor who missed the five best days each year. So the guy who missed no days had a CAGR of 13.2%. The one who missed top 5 days uh, each year had a loss of 7.6%. And the guy who missed the worst 5 days made 38% CAGR. So while it is very important that you don't miss the top few days, it is equally important to miss the worst 5 days if it is possible. So that's what the data is telling us. Now, if we see the annual calendar year return versus missing top 5 days, and let me just sort this. In 2008, if you missed the top 5 days, you would have been at, let me just see this. You would have been at minus 65%. So 51% would have gone to negative 65%. Uh, in 2011, it would have gone from 25 to 36. And just look at few of these years. 1992, if you missed the top 5 days, you would have been at minus 26%. In 1990, 40% would have become minus 12%. And in boom years like 91, just 5 days accounted for more than 40% of the gains. In 2009, just 5 days accounted for more than 50% of the gain out of 70%. So huge ramifications for missing the top 5 days. Now, penalty for missing the upside is far more severe than the reward for avoiding the downside. And the cost of trying to time the market is too high. So, why does it not make any sense? So, what happens is when the market starts to crash, as we have seen in dot com times or GFC or COVID times or other smaller crashes, these really big down days are followed by really big up days. So the best days of the year or the best days of the even decade are very near the crash days. So for instance, in this chart, this is December 2007, and on 17th of December, market fell by nearly 4.5%. Significant number of people will panic on this day and sell their holdings. So the market crash days are those days where significant number of people will basically throw in the towel, and that is why the market is crashing. See, you have to understand why the market takes a deep dive down, because too many people are selling out on that day and too few people are willing to buy their selling volumes, and hence there is more selling than buying, and hence the price discovery tends to go down as sellers race against each other to sell out. But what happened post that on 24th December? Markets recovered and had one of the best days of the year just in 3 days' time. And on 24th December, you were up by 4%, one of the best days of the year. So the best days of the year are usually found near the worst days of the years. Again, in January 2008, two of the biggest falls of 8% and 5%, they came in very close to each other, the biggest falls. But they were followed by 6% and 7% recovery days also. In November 2008, post the Lehman crisis, there was a single day fall of 12%, but multiple top days in the next few sessions. So each and every fall crisis results in some of the best days being aligned very near it. And during the falls, many weekends, newer investors, not so confident investors sell out. And then once the reverse reaction starts, most investors are stuck with like deer in the headlight syndrome, and they're not able to react because they've just sold. You bought something at 100 rupees, you've sold it at 20, and now suddenly it has 40. You are unable to buy it because you've seen 20, there is recency bias, there's anchoring, and you were completely despondent when you sold it. You said, I don't want to be in this stock anymore. And now that stock has suddenly started to rise. It is very difficult to get onto that stock. So that same pattern repeats again and again and again. Markets will build up, people will, you know, fill stocks that they really don't believe in also up to their gills, and then the bubble will burst. The over ownership will go from over ownership, the stock ownership will go from over ownership to under ownership, from overbought to oversold, and the cycle will rinse and repeat each time. So there is nothing new in those cycles because that is human nature. You can't avoid that. So 22 out of 30 best days from 2005 to 21 occurred during just 1 year. So, you can imagine the kind of concentrated down days 2008 had, ranging from 4.8%, uh, 4.5% to almost 17% kind of down days, up days, sorry. Uh, and this kind of clubbing, let's say you were holding in the market 2005, 6, 7, but in 8, by the time the pain got a little bad, you decided that okay, I can't hold on any further, and I'm getting out of this market. Now, if you see the dates, just in October you had 3 days which were clubbed 4%, 4%, 5%. Or in November, then you had several days. Sorry, October 2008 is here. Not that was 2007. 2008, you can see just if for in after Lehman happened, if you had moved out towards end of September 2008 and said that okay, I will come back after 3 months into the market, you would have missed all these days that were there till December, and that would have meant that you would have missed a significant part of the rally that came through post the bottom getting made. Similarly, in COVID-19, the same thing happened, where the best days were very close together, and each of these days basically gave you 8.8, 6.6, and 5.8 kind of returns. Four of the top 30 days in 2020 were concentrated uh, very near each other post the COVID crisis. So the systematic exit basically should we always follow buy and hold. The key isn't if you sell, but why you sell. So we have to go back and see that while this was a theoretical debate so far, where people will normally not be missing up days if they stayed invested. But the problem with staying invested is that index is one thing, you're making 12% returns on index, and index is like a pseudo momentum strategy where stocks will be changed if they're not working. But a lot of people don't invest that way. A lot of people will have their own portfolio picked basis, whatever be the idea of picking. And those stocks, when they go down, they don't necessarily come back up, at least not in the same season. And a lot of people are saddled with the excesses of that previous bubble. If it was an infrastructure bubble, people will be saddled with infrastructure stocks. If it was a metal and commodities bubble, you will be saddled with commodity stocks. If it was a real estate bubble like 2008, 9, 10, you would be saddled with real estate stocks, and that is going to come back perhaps in 10 years, perhaps in 5 years. You never know. Perhaps those companies get so debt ridden that they never come back. That is also possible. So the idea is that your exiting from the market, if at all, should be based on your strategy. If your strategy demands an exit, certainly make an exit. If your defined system tells you you have to exit here, certainly make an exit, but not because of just fear and panic. So if you are holding, let's say, a stock in which you have immense confidence for the next 10 years, 20 years, basis whatever be the thesis that you're following, then don't sell out because of the whole idea that I'll sell out today, but 5 days later I'll come back in. That causes the most missing of up days for most people, because this whole idea that you can time the market, I'll be able to get out, but others are not as smart as me, and hence they will take some time to get out post I get out, and that would mean that price would be much lower in 5 days or 10 days, and hence I will be able to get in. That may happen to you in a blue moon, but it won't happen consistently, and that is what people have found out. So the key takeaways from this exercise is that the best rallies will often emerge from panic, and our jobs as investors is to endure and not aimlessly time the market move. So in case you are following a structured uh, uh, let's say a strategy, a momentum strategy for instance, and if that is exiting, then certainly exit, because that is as per the design of that strategy. But let's say if you are a buy and hold investor, where you are investing basis long term prospects of a company, then don't try to do this timing business that let me get out right now and get in get in later on, because that will not work. It's like almost like daily noise that is happening, and basis that noise, if you're taking decisions, then you're actually not really a long term investor. And the only way you can ride over these emotions is basically finding that discipline in your investing, that write down your investing rules, write down how you're going to react if crisis will happen. Do you have to think about the crisis much before it comes and hits you? So you can do mental models. What if, my portfolio goes down 30%, and index is down so many percent? What will I be doing? Is that going to be a burden on my investment thesis? Because for a lot of people, price is not the reason why they are buying or selling stocks. Buying stocks, rather, price is not the reason why they're buying stocks. But when it comes to selling, somehow price becomes a reason for many people to sell, even if their buying was not based on it. So it is very, very simple. If you are following a price based thesis for buying, you have to follow a price based thesis for selling also. But if you are buying because of long term fundamental prospects and exiting because of price, I think that's a broken story right there. So let us know in the comments how you have uh, you know done this harakiri ever in your life, where you've sold off uh, stocks basis fear and panic, and then missed the resulting up move from the market. That is, at least it has happened for me. I'm not sure if it has happened for you or not. And uh, usually, one or two such episodes will make you a much better investor in terms of learning from the market. But I'm hoping that with all this content and learnings, you should not be the one experimenting it on your investing journey. Hopefully, you will learn and not subject yourself to that kind of a mistake. But certainly, do write in with your comments how you overcome that situation. And of course, if you have liked this video, you may also like this other video that we did recently. Beware, you are over invested. That is also, some parts of the video there are aligned with the thoughts that I have presented today. So do watch that as well. And certainly do subscribe to the channel and like and share these videos if you like the content. Thank you. Bye bye.